Okay. Give you a little bit of background. When we were putting the conference together, I had just got back from the Retirement Income Summit, and one of the hottest topics that was there was reverse mortgages. And I've known Ron 4 or 5 years, I guess now. Lukewarm on reverse mortgages before, just the cost blew me away. At the conference, they were talking about why it was important. I don't want to steal his thunder, but when you get a group of 350, 400 financial advisors, and they're all talking about one topic, it means that there's some genuine interest in it. It does provide some safety nets that the way that most people plan is with an equity line. Well, one of the topics that came up was in 2008 when they needed it the most, when the market went down. Guess what? The banks froze their equity lines. And then they were forced to make a really bad decision. So the purpose of this is for Ron to explain it and then have a dialogue of how you can use it in your process. I will give you one caveat. You're technically prohibited. In fact, I think you told me there was a line on there. It says, are you going to use the proceeds from this to buy life insurance? Yeah, and you're opening yourself up there. But one of the nice things about the reverse mortgage is you can wipe out. And do you have the statistics on how many people go into retirement with? Yeah, yeah, and it was higher than that. I think they gave like 60–70% of people are going into retirement with a mortgage. For those people, it is besides insurance, health insurance, it is the single largest expense. And by using a reverse mortgage, you can basically wipe out that expense and use that money for something that they really need, which we'll talk about long-term care, which 70% of people will have some type of long-term care and only 5% have any insurance on it. So with that, Ron Heath, he's got a book that he's going to be sending you. We're waiting for it to come in. He's got some packets to hand out. The book
have in their home. So, reverse mortgages. They started in 1962. A woman, I want to say it was in the Northeast, maybe Mass, somewhere like that, approached her bank. My husband's dead. I own a home free and clear. Can you guys buy it back from me and pay me while I live there? So thus began the world of reverse mortgages, and it continued being a private bank offered loan until 1989, although we still have some. But 95% of them now use what was created in 1989, which is called the home equity conversion mortgage. We call it a HECM. People still call it a reverse mortgage. It was at the behest of Reagan and Fred Thompson that we create this program to help our senior homeowners, the wave of baby boomers that were going to be coming, be able to use their home equity in a manner that didn't create a debt service on a monthly basis. So they created the HECM. Basically what the HECM is a payment deferred loan where we will lend a certain percentage of the home value to a homeowner based on their age, prevailing interest rates, and whatever the appraised value is. So the easy math is if someone's 62, we're probably going to lend them 50% of the home value. If someone's 95, we're going to lend them 75%. It's easy to understand because the term of the loan gets shorter as the person gets older. We lend money to a 62-year-old, we imagine that whatever they borrow and the interest accrual is going to continue for about 27 years on average. That's why we limit it to 50%. If we lend to a 95-year-old person, we imagine we're going to get paid back in the next week. So that's just how we calculate things. When we determine the amount that we're going to loan somebody, they have different options in how they can take their funding. As Steve mentioned, and as I experienced, 50% of my clients are in retirement. They're 64, 5, 7, 70. They have a current mortgage on their home. They'll use reverse mortgage proceeds to retire that debt, which by default creates greater income on a monthly basis because now they no longer have the debt service of a traditional mortgage payment. Other clients who have a free and clear home will establish a line of credit. The reverse mortgage or the HECM line of credit has a growth factor to it. So if you've ever gotten a HELOC, in 8, 9, and 10, like Steve said, man, a bank will review your income, and if they don't like your income, they will freeze it. They may reduce it. They may take it away from you completely. And here's the bigger thing with retirees. They get a HELOC when they're 55. They never use it. 68, they start having needs, perhaps medical needs, home repairs, all of these things. They start using their home equity line of credit. So they've had this thing, for quite a few years. They create a debt. And did you know that Wells Fargo at 10 years, at the end of a 10-year period, they no longer say we're just satisfied with you paying us interest? They call the whole thing due. Not in a balloon style, but they say now it's principal and interest. So I meet so many retirees with a traditional home equity line of credit that were paying $200 a month in interest. Now all of a sudden they're going to $1,700 a month principal and interest on a regular HELOC. The HECM doesn't have any of that danger to it. A HECM line of credit is simply a line of credit that's established based on age, appraisal, and interest rates. It can never be frozen. It can never be called because we're not going to base the ability to repay on what their income is because we don't ask them to repay it. The other thing about a HECM line of credit is that it will continue to grow over time. So it's not stagnant. A senior approaches me that's 62 that has a $300,000 house, I give them a $150,000 line of credit. His line of credit will grow annually, currently, at about 6.1%. So it'll go from 150 to 158, 167, 178. That's what a HECM line of credit does. What drives the growth? It's a calculation that FHA has, but the simple explanation is home appreciation and they're getting older. Those two things occur which allow us to release more equity so that they can borrow against it. Yes. National, 4%. And that's the other beautiful thing about the FHA HECM. When we calculate that 50% LTV for a 62-year-old, we've anticipated future home value at a 4% appreciation. They set the line of credit, it goes into motion and begins to grow. They never review the actual value of the home in the future. It's a guaranteed growing line of credit, irregardless of what home values do. Local appraiser, a local FHA appraiser. Correct. We determine the market value. Mm-hmm. No, not at all. Yes. Okay. So there's two ups and downs and curves that I'll address. One is the actual home value. That's an up, down, a curve, a right, a left. 2008, it was a plummet. It doesn't impact the reverse mortgage. So once everything's calculated and we go out the gate, nothing changes based on home value. That becomes a non-issue. As far as interest rates go, they are an annually adjusting interest rate tied to the LIBOR. The beautiful thing about, in this situation, a line of credit that we establish for a borrower, the growth rate on the line of credit, I told you it went from 150 to 157, 166. That's tied to the note rate. So if the note rate's 5%, anytime they borrow money, interest is now going to accrue on that debt at a 5% rate. The line of credit growth rate is that 5% plus 1.25%. So my line of credit is going to grow at 6.25%. If the rates go down, then the growth rate will reduce. But if the rates go up, the note rate, where they're going to experience the interest charges, if it goes to 9, the growth rate on the line of credit is 10.25. So for a HECM borrower who's using their asset to create a bucket of money for future income, rising interest rates benefit them. But you say, well, they're going to borrow the money and the rate's gone up, that's going to increase the debt. That's true. So let's talk about the debt. FHA insures these loans. So let's say in 10 years, mom and dad decide to sell the property and move on. Their responsibility, because they've always maintained title to the home, the bank has no ownership of the home. It's theirs. They decide to sell in 10 years. They sell the property for a number, they pay off whatever the debt is, whatever they borrowed and the interest that's accrued, and they walk away with the net equity. So if you have a client that's considering this, but they say, we are going to relocate in 10 years, okay, that's great. You can establish a line of credit. It will give you a buffer, and it will give you that, it'll remove that fear and give you that peace of mind. But my advice is to use it sparingly, because you're going to create a debt that has interest compounding on it, chipping away at your net equity when you sell it in 10 years. But let's say they do this, they set up the line of credit, they use it, and then at 90, they decide to move in with their daughter because dad's dead, mom's not well, daughter has a mother-in-law suite. If the home value is still greater than the debt, sell the home, pay the debt off, keep the net equity. If at 90, because she's lived beyond our life, what we expected her life to be, and if she has exhausted all funds, and if interest has accrued for a much longer period of time, FHA insures the loan that may be underwater. So if mom at that time moves in with daughter, she simply takes all of her personal effects, calls the bank, says, I've signed the deeds, it's yours, and walks away. They're non-recourse loans, which means that no judgment can be rendered against the borrower, nor the heirs if they inherit the home. So that's the larger protection, is that I think the last stats I read, almost 90% of people want to live and die in their home. They don't want to move. So if they set this up and if they use it as additional income, then in the end, they're either going to leave a home to their heirs that has net equity in it, or they're going to leave a home to their heirs that they have no obligation for. They can simply walk away. Either way, they win. And the reverse mortgage is for the homeowner. It's to take away that number one fear of running out of money. It's to let them sleep at night, knowing I have another bucket of income. That's really what it's for. Some of the nuts and bolts about a person who has one: you got to pay your property taxes. All of us do. You've got to maintain homeowners insurance, because if it burns down, we want you to rebuild it. If you have HOA dues, you got to pay them because they could put a lien on the property, and you need to maintain the home. But isn't that the responsibility of every homeowner? So we're not asking them to do anything that they normally wouldn't do. If they don't do one of those things, then we do have the right to foreclose, to call the loan due and payable. Yes?
had one customer that did the reverse mortgage, but when I did a home inspection, and then they had a roof problem, right? And the insurance company was, you know, it was a real problem with the hail and disputes going back and forth. So they had to, you know, pay this money out of their pocket to replace the roof. You know, inside this loan, you know, and a lot of them set the money. Some of them take like distributions, like a Social Security,
Like
some do. Right. And so the extra money, you know, for a $10,000 roof just wasn't there. So how would you address that particular problem if you have plumbing, water damage, and heating and air? I mean, major mechanical breakdown. How does that help that senior? Because it can become distressing.
Well, it can. So they're going to have those issues with or without a reverse mortgage. Right. So they're going to have to come up with the money somehow.
I mean, well, I guess what I'm asking is,
what does the lender do?
Can they borrow? I mean, do they come back to you guys, or do they have to find some private person?
Yeah, I mean, if that's their only asset, are there contingencies in the loan to be able to draw off of for maintenance issues like that?
There are. So if somebody's annuitized their reverse mortgage and they're receiving a monthly payment, and then all of a sudden they have unexpected expenses, they can alter the structure of the loan. It's a $20 change fee. They can reduce the monthly payment to a point where they create a line of credit, and then they can draw from the line of credit for the repairs. So you can unwind whatever, you know, payment schedule you put in place.
And we've got capacity within the line of credit. There's no restrictions.
None. You can't build a meth lab. I mean, something like that. I do have in your folder, there's 25 uses of reverse mortgages. So to your point, it can be done for anything. It really can. But I'm just here to say that as far as the nuts and bolts of this loan, it's safer than any loan somebody 62 or older would get, because there's no payment obligation. There's actually a document in the closing package that says you have no personal liability to repay this loan. So you're not going to get a better loan in retirement. What are people using it for? Let me kind of address, well, first, any other questions about the structure of the loan itself?
Yeah, one thing I got a comment says, I said, I want you to talk to Ron Heath. They want to say, I want to look and talk to 3 or 4 different agents. Is there any variables between what agent can offer versus another, or the origination fee, whatever?
Yeah, there are. And when I meet with clients, honestly, I'm too honest for my own good, I'm sure. But when we're done and I show them a quote and they see what the costs are and all of that, I will say, now, Bank of America, or Bank of North Carolina does these. Yadkin Bank, which is now whatever they're called now, they just got bought. They do them. Don't call AAG. Please don't call AAG. You're just going to get hammered on the phone. They're going to hit you with high cost. I try to get them to get 2 or 3 other local quotes. And what I tell them is, if you find something that's better than what we have, I can get my management to at least give you that or something better. So I encourage them to shop. The only thing really that changes is the origination fee that the lenders charge. FHA is going to charge their percentage for upfront insurance. The attorney wants his money. The appraiser wants his money. All of those things are going to be the same. Yeah, they may vary some. And they're not what they used to be. When I did a loan in 2008 on a $500,000 house, the closing costs were, hold on, 6, 10, 16, a servicing set-aside fee, 4 is 20, other closing costs 25, 22.5. Rolled in cost, so it's not out of pocket. Now I can do that same loan on a $500,000 house for $2,500, 8, 6, 8,500, about 11, 12,000. So the cost have come way down on the loans. Will they go back up? Depends on what the secondary market says about our loans and how much they like them and what we're making when we sell them. But right now, they're the least expensive they've ever been. And the lending amount that we can give is the greatest because we're in a low interest rate environment. Yeah, and it is the most regulated. Here's a horror story. Loan officers used to meet with clients that the husband was 63 and the wife was 57. He would convince the couple that the wife should come off title, the husband will be the borrower. Don't worry about it. When, you know, Miss Smith, you turn 62, we'll refinance this thing and get you on as a borrower. Well, that guy was gone. It was one and done. He never cared about him again. Husband dies a year later of a heart attack or cancer. Wife is 58. Loan's due and payable. If she can't sell it and pay back the loan, they're going to foreclose. That's a horror story that we heard about reverse mortgages. It wasn't the loan's fault. It was a loan officer recommending bad use. Kind of like annuities. Annuities get a bad rap, but there's great annuities. It's just they get sold in the wrong way. So the product gets the black eye rather than the fella that was doing the business. That's the same thing with reverse mortgages. Yes, sir?
So what does the perfect client scenario look like to you? So when we
Wow.
see those people, we would know, say, oh, you're the perfect person. Let me call Ron. He can help you.
Anybody born in 1955? Anybody 62 or older? I mean, think about it. Who's heard of Dr. Wade Pfau? You heard that name, Dr. Wade Pfau? He is a CFA. Is that a certified financial analyst? What is it? Okay. Chartered financial analyst, certified financial analyst. This guy is about this tall. He's tiny. He's in his 30s, but he is brilliant. He's with the American College of Financial Services. He has done all the research, and he wrote this book. And what I'm going to do, I have these on order. I'm going to send every one of you one of these books. I encourage you to read it. Reverse mortgage is the worst possible way to use a reverse mortgage is as a last resort. Worst possible way. Let's say you've got somebody in a Monte Carlo simulation. Is that me? Did you turn it on? FINRA used to say reverse mortgages were the loan of last resort. 4.5 years ago, it's gone. They took that out of their definition. It's the worst use of a reverse mortgage. In your booklet, you're going to see a spreadsheet that Dr. Barry Sachs did. He shows two brothers. One that they both have a $500,000 portfolio. They both have a home free and clear. The one brother's financial advisor is kind of old school, last resort. He spends his portfolio down to zero. I think he's 88 or 89 when he runs out of money. Turns on a reverse mortgage, spends that until he dies at 92 or 3. The other brother, financial advisor, says, hey, wait, you're 65, 25, whatever. Let's set up a reverse mortgage line of credit just for the future. We're going to use it as a protection against the negative sequence of returns. So rather than taking the $500,000 portfolio and skinnying 100 off into a money market, he was able to leave all 500 invested. But when the market turns south, we don't draw from the portfolio. You'll see in there he drew from the reverse mortgage line of credit. Every year after a down market, reverse mortgage draws, not portfolio draws. This brother had $1 million portfolio when he died, simply because they were protecting against a negative return. And that's how they used housing wealth to do it. It's brilliant, but you have to do it early, and that's what Dr. Pfau says. You have to do it early. It's in that booklet, that packet I gave you. Yep. And what you'll see on the back of that is an amortization schedule of a $500,000 homeowner, free and clear, setting up a line of credit. The third column from the right, you'll see the growth on the line of credit that I'm talking about. So the spreadsheet's in there. It's interesting. It's an interesting read to look at. The balance on his reverse mortgage is greater than his brother's, who used it as a last resort. True. But when you subtract overall debt, which he does at the bottom, on the home from the portfolio versus the net is 900,000 or something crazy. 500,000, 600,000, whatever the net is. So that's just one way that Dr. Pfau says, hey, rethink reverse mortgages, rethink housing wealth. When we're 20 and we buy a house, that home is an investment. We hope we're going to see an appreciation. We hope that we're going to be able to turn that investment into something else in the future. When I'm 62, if I'm living in the home I want to live in, it's not an investment for me. It's a liability. Cost me taxes, cost me insurance, cost me upkeep. It's an investment for my children, whatever appreciation is there for my children. But we're talking about the fear that people have of running out of money. and you got to live somewhere. Here's some other concepts. We talked about Social Security and getting to full retirement age. But what if your client insists that he wants to retire at 62? What if he sets up a line of credit and he draws income from the line of credit until he hits full retirement age? He just took an 8% increase in pay every year. Then he shuts the line of credit off when he starts drawing social. It starts building back up. Heck, if he's making enough money, he can make payments on his reverse mortgage line of credit, pay the debt down, but every dollar he pays it down goes back on the line of credit. And then he can play this game all day long as an option. I said 50% of the people I work with have mortgages when they come into retirement. Let's say this $500,000 homeowner has a $250,000 mortgage. He's carrying a monthly payment of $2,200 a month. We do the reverse. We flip that debt over into a payment deferred loan, a reverse mortgage. He just found $2,200, $2,500 a month. He's 62, 63, good health. What can he qualify for? Beth? Long-term care. And he just found $2,200 a month to pay for long-term care. Or maybe this guy with the $250,000 line of credit that doesn't have a debt on it says, you know what, I think I'm going to take 100 of it and do 100 dump in and buy a hybrid. Now, we're not trying to sell products, right, Steve? But we're trying to maximize financial security. And if he can take 100 grand in equity and dump it into a hybrid policy and get how much in long-term care coverage? 300. Minimal cost. And even if his health isn't that good, I think dump-ins are a little easier. The underwriters are a little easier on that.
We'll talk about the differences and who qualifies for what.
Okay.
But it's a Michael Kitsis also was talking about how you can eliminate the downturn in the market your first 2 years calls in retirement. It basically takes the negative market impact out of a portfolio. Having that, almost nobody succeeds. And so but then doing it over there. We had an interesting conversation. What if you do reverse mortgage and then pay it back later on when you have the upturns in the market from the portfolio? If you're really concerned about not leaving that debt to your kids. The other thing that was really helpful when Wade was talking was he said, you need to think about your house as an asset, not as an emotion. And that at the end of the day, if you take $100,000 out of your stock portfolio, or you take $100,000 out of your house, when you drop down that bottom line, your net worth didn't change either way. And the comfort that people have by being able to stay in their house with home health care, that's a life that most would rather have instead of going to a nursing home and dying that way. And you basically, as long as you can maintain it, you can draw from it to maintain it. You're guaranteeing that they're going to be able to stay. So we've got to get to the next.
I'm sorry. I'm a windy person.
That's all right.
But again, I'm the professional. I know this loan. If you need me to explain it to you or anybody, my card's in there. That's just, don't feel like you need to understand the loan. That's my job.
That's exactly.
And I will send every single one of you one of these books. You're going to get, it's.
Ron, one question. Am I doing this out of the kindness of my heart, or have you found a way in this regulated way to compensate me, or am I just giving it to you?
You know what I love?
My own guy.
What I love.
In my local area.
What are you talking about? Your own reverse mortgage guy?
Yeah.
Oh, use whoever you're comfortable with.
Okay.
Don't worry about me.